You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to the Financial Survival Network. Well, many of you may have given up on the stock market, and here it is. It's only December 19th, but you should think again after you hear from my next guest, Darrin Erickson. Darrin, you are a global portfolio manager and author of a new book, Global Investing, A Practical Guide to the World's Best Financial Opportunities. Darrin, are there still any, first welcome, are there still any financial opportunities left, or have they all been smoked in the wake of the Federal Reserve's aggressive interest rate increase policy?
Thank you, Kerry. This is not the first time we've seen this. The market, as you know, goes in cycles. We have obviously a contractionary phase with the market as the Fed raises interest rates. It's creating opportunities for investors. Frankly, as a equity portfolio manager, I get excited when I see stock prices falling as they are now. I don't think we're quite finished with it yet in terms of the market pullback, but this is certainly starting to create some opportunities for long-term investors.
All right. Where are the best opportunities on the planet now? Is there a particular market or a particular sector? We're looking at energy, resources, defensive sectors such as consumer goods. Your Procter & Gamble types selling you shaving cream and razor blades. So regardless how bad the economy is, unless we all want to look like Abe Lincoln and never use another stick of deodorant, these companies got a lock. What is your take on it?
I think owning good businesses and buying them at good prices will inevitably lead to strong results. So today, in the short term at least, you're probably better off owning those types of companies that are, selling things, items, services that we can't live without. And so, consumer staples products or companies right now look attractive on a relative basis. Longer term, you're setting up some good opportunities within higher growth segments of the market. But in the short term, the tech sector is something I'd probably steer clear of in general. That's where you're going to see some opportunities coming out of this. But in the short term, they are more likely to fall in value as the Fed continues to raise rates. In terms of geographically speaking, if you look at Europe and Asia, valuations are a lot more attractive outside of North America. That's something that we're seeing. Emerging markets in particular look very attractively valued.
Okay, so emerging markets like China. Look, if we've learned one thing from what's happened recently, is that you can't just trust Chinese accounting, right? I mean, right. Chinese accounting they don't know what a GAAP is from a fraud, right? I mean, GAAP doesn't apply to the Chinese, does it?
Correct. We've seen one positive development in that regard. There's been an attempt by U.S. regulators to obtain audit data from Chinese companies, and that's been moving in the right direction. When we talk about emerging markets, we're also looking at places like Indonesia, India, South Korea, for example. So there's a lot of great businesses in those regions that are really world-class organizations that we think offer tremendous value long term.
Okay. So, but you got to be able to pick out the real ones from the fake ones, right? And
absolutely,
numbers on the balance sheet in a Chinese company, your average Chinese company, mean absolutely nothing. They could be complete fiction, right?
They could be, yes. You need to be very careful. one thing that we try to focus on, obviously, is we need to be able to look at financial statements that we think are reliable. We need to be able to understand, the MD&A that management team puts out, that sort of thing. And so we're looking for companies where we do have access to that information in English so that we can actually understand it. And also, if you focus on companies that do offer ADRs, most investors, retail investors, will invest in a foreign company using an ADR for its simplicity, the fact that it trades on a local exchange. So a lot of those, depending on the type of ADR, many of them are subject to U.S. accounting rules, and those that aren't at least provide financial statements and MD&A, the management discussion analysis, in English. So we're focused on those types of companies. We also, as an institutional investor, I work with a lot of large brokerage firms. So we have coverage, local coverage through them with some of the bigger names like Morgan Stanley, Goldman Sachs, that sort of thing. So if you have access to that type of information, that type of, feet on the ground type of analysis, then, you can have a much higher confidence level in the company you're investing in.
Okay. But, things being what they are. So emerging markets, how do you define them and which ones look best? That's
a great question. The term emerging markets, I think, has some negative connotations that have, lingered from past experiences. And in a lot of cases, these were like backward agrarian-based economies that hadn't really industrialized yet. So, the terminology is a little bit difficult to pin down. The way I look at it is, I look at emerging markets or emerging economies as high growth economies that haven't fully industrialized to the standard that we're at here in North America or in Western Europe, for example. Even parts of Asia like Japan are obviously very advanced economies. So, but when you look at the infrastructure in a country like China or South Korea, it's very advanced, in the urban centers. And so, as well, these countries are contributing more in terms of technological development. The leading country in terms of patent applications is China. Obviously, the U.S. is going to continue to be a leader there as well, as will other Western European countries. But, these are high growth economies is how I prefer to look at them. And as long as one thing we're very focused on, or I'm focused on, is that, the political stability of the country, the financial, the setup of the financial markets will protect shareholder rights. So one criteria I use for investing in a foreign company is the sovereign credit rating of the country itself. If it's below investment grade, then I avoid it completely. So I wouldn't advise people go out and invest in countries where, the rule of law is completely ignored, where shareholder rights mean nothing. You do have to be careful with where you're investing. So, for example, one country I think is interesting is India. There's obviously a tremendous growth opportunity there, but we're very focused on how we get exposure to a country like India. We own a bank, HDFC Bank. It's the largest bank in India. A very, very well-run organization. In Indonesia, similarly, we own Bank Central Asia, that I think really is, in terms of the technology and the scale, is one of the world's leading banks, but it's not really thought of too much here in North America. A lot of people don't know about it. Now, that being said, there's a lot of great opportunities in developed nations as well.
Any of these companies that you look for, do you care about dividend yield, anything like that?
Definitely. Ultimately, as an investor, you want a return of your capital. So companies that can grow their dividends, pay a reasonable dividend yield, and that can grow, more importantly, grow those dividends over time, are something that I focus on pretty closely. So, the companies that, if you if you look at a company's growth profile or dividend growth profile over years, and as an investor, you focus on that, you focus on how the business is doing, and you basically train yourself to think like a business owner, and you focus on the business fundamentals. When you would get into situations like we are today, you don't see those as threats anymore. You see them as opportunities. This is an opportunity to buy great businesses at better prices than you could have a year ago.
And if they're paying a dividend, the yield is way up and you get paid to wait, right?
Absolutely.
So cash flow king now. You picking bigger companies because, look, in this environment, smaller companies have less staying power than bigger companies. We know that. That's why they stick around through cycles, and a lot of them even keep paying dividends. So you look for that stability.
Definitely. I tend to focus on industry leaders. So the top, 1, 2, 3 companies in a given industry. These are companies that can actually come out of weak economic environments stronger. They're able to take advantage of weakness seen in other inferior businesses. So, we saw it, for example, in the pandemic sell-off. Louis Vuitton, a company that I really like, one of the best run businesses out there, I think. In fact, I think Bernard Arnault, the chairman, was recently named the wealthiest individual in the world.
That is correct.
That's an incredibly well-run business. They have over 70 leading luxury brands and about 2 times market share, their closest competitor. When the pandemic hit, they actually used that to renegotiate the purchase price of Tiffany. They had just announced the purchase of Tiffany prior to the pandemic. So they're able to use that as a means to better the terms of the agreement. So these companies, because they're they're large, they're stable, and they're able to grow their dividends and take advantage of opportunities like we're seeing today.
Hey, what about a company like Verizon? Right now, Verizon's yielding 7%. Now, we could talk about their spotty customer service history, other mistakes they've made, but Verizon is like second biggest first biggest cell phone carrier in the U.S. Cells aren't going anywhere unless Elon Musk gives us all a Pi phone, and then we'll all be communicating through satellite. Maybe eventually that's going to happen, but not for the foreseeable future. Not obviously, it's in the U.S. and the developed world, but it seems to be on sale right now.
Don't just survive, thrive. The Financial Survival Network.
Osino Resources is a Ross Beatty-backed gold exploration company in mining-friendly Namibia. Osino's district-scale land package is situated near 2 producing gold mines, one of which Osino's management team previously developed and sold to B2 Gold. Osino's founders and management are experienced mining professionals who have already successfully developed and sold 2 companies in the past 7 years. Osino has a tight share structure, and with its current treasury, it can self-fund the advancement of its gold discovery into at least 2022. This is an exploration company with drills turning that you'll definitely want to pay attention to. Osino trades in New York under the ticker OSIIF and in Toronto under the ticker OSI. To learn more, go to osinoresources.com. That's osinoresources.com.
This is the Financial Survival Network. The information you need to thrive now more than ever.
It certainly is. Trading at a forward PE of about 7 times, as you mentioned, a 7% dividend yield. I think at these levels, Verizon is quite attractive. Another company in the same industry we like, if you wanted to look for some foreign business, would be Deutsche Telekom. They own roughly half of T-Mobile. T-Mobile has been taking share in the U.S. market, performing very, very well.
I don't understand why, because honestly, all I care about is can I get a signal? And that's hit or miss with them. But yeah, I guess I understand you got to have competition, right?
Well, what's interesting about Deutsche Telekom is that when you back out that Verizon stake that they own, the rest of the company was being valued at pretty much zero. And they still have about $10 billion in cell tower assets in Europe. And of course, they have their entire European business. So again, I think Verizon's a great investment. It's a good company, obviously yielding a pretty attractive dividend right now. And I think, longer term, if you're a long-term investor, this is a great time to be looking at that company.
Yeah. All right. So we're almost talking here really about value investing, but I guess with a twist, right?
A little bit of a twist, yeah. So we are focused, or I'm focused on, what you're getting when you pay up for a business. What are you paying for that? What are you getting? So valuation is important. In fact, if you look at where you're paying, like where the market is today and forward returns, obviously, the lower the PE or the price to cash flow, because I look at cash flow as well and free cash flow. If you're paying a reasonable price for it today, you're more likely to make money 3, 5, 10 years out. So I am focused on value, but again, it's not looking for the cheapest stocks out there. It's looking for the best stocks out there at a good price. I think the type of business, owning a quality business that's well run, has a really strong management team, is what's going to make you money in the long run.
All right. I like that. I like it. And, well-run companies, because you're buying a piece of a business, as Benjamin Graham used to say, as Warren Buffett says, he buys the whole business oftentimes. Yep. And that's the best way to look at it, I guess. And then in terms of which piece of the business you're going to buy, what kind of screen do you use initially to identify potential prospects?
So we'll screen for a variety of fundamental factors. We look at dividend yield. We look at price to earnings, price to cash flow, free cash flow yield. We'll look at trailing growth rates, forward expected growth rates. So in terms of earnings and dividends. And really, I think what it comes down to at the end of it, the most important factor is expected dividend growth. So we're looking for companies that don't have excessive payout ratios. They pay not necessarily the highest dividends today, but we have a high expectation that they can grow their dividend going forward. So there's a number of factors that we'll screen for. And then of course, once we do that, we highlight the companies we think are most interesting, and then we'll do a deeper dive and look at the financial statements and that sort of thing.
Okay. Are there any particular industries that you are avoiding like the plague?
Not really. I think I tend to be a little less focused at the moment on technology, just because valuations in a lot of businesses are still pretty high, and I think have room to come down. But technology tends to be the best performer over a full market cycle. Technology performs quite well. The time it doesn't perform well is when interest rates are going up and we're in a bear market, which we are today. So on a short-term basis, that's one that I'm tending to avoid.
Okay. Tell me your take on the energy sector, because on our show, many of you out there are energy investors. You've done amazingly well the past year. Energy, has it had its day, or do we continue onward and upward with it?
I still think energy is in an attractive position. Obviously, a lot of, in terms of valuations, they've come up quite a bit in the last year or so, which has been great for investors. There's still some value there. And, as much as we're moving toward green energy or renewable energy, fossil fuel use and the like is not going to disappear today. It's going to take a long time to make that transition to renewable energy. And I still think there's some room for those stocks to run higher here.
So you don't think our energy transition can just be legislated into existence, if I'm understanding you correctly?
Yeah, it's just not going to happen. I mean, you can, not to say that moving toward cleaner energy is not it's a good thing, I suppose. But reality is, we can't run our economies off of what's available today in terms of renewable energy. We need oil and gas.
Yeah. I mean, it's a nice thing if we could afford it. And I'm not at all convinced that in its current iteration, it is affordable or desirable. But I guess we can leave that discussion to others. But agnostically, you're agnostic towards energy, and it's agnostic in terms of values of technology transitions and such, but it sounds like you're bullish as far as the investment thesis for the sector goes.
Currently, yeah, I think the one thing we have to watch there is whether or not we actually do get a recession. A global recession obviously would hurt energy demand, but at this point, it looks still like a shallow recession is possible, that the Fed could create a soft landing. I'm not 100% convinced that's what's going to happen, but for the time being, the outlook for energy is still fairly robust.
All right. Well, we're going to have to see about that. I'm not sure about recessions, but even in the face of a recession, when you got declining production due to faulty government policies throughout the world, and you still got some base consumption that has to be done, and we see in like Europe, the energy producers are cleaning clock right now, as long as they don't do a windfall profits tax on them. So could be good. Is there any other sector that you have a preference towards that you think we should be aware of?
Yeah, the one I would highlight would be healthcare. Just when you look at long-term trends and the economic growth we're seeing in certain parts of the world, the one thing that really stands out is that as countries grow their economies, they tend to shift increasingly more money into the healthcare sector. And so, there's a lot of great businesses, both here in North America and in Japan and Europe that will benefit from that long-term trend as these countries shift more and more of their GDP toward healthcare spending. And that's I think a very long-term trend, but one that we'll certainly see play out.
Hey, and and the world's population, especially in the developed world, is getting older, and therefore demand dynamics. Unless we have a health revolution in the world and people stop eating sugar, basically, and other bad items. This is just going to continue on, and the older you are, the more healthcare you consume. It's just a fact of life. Just the cost, especially here in the States, is really 20% of GDP, and that's just unsustainable. Hey, so the biggest super trend you see going ahead, besides healthcare, aging populations, the biggest trend that you think creates the biggest opportunity moving ahead? What do you think that is, Darrin?
Really, digitization, just continued shift of businesses toward the digital world. Blockchain. I'm not a cryptocurrency investor. I don't have a lot of faith in that market, but I think blockchain as a technology has a lot of value and can transform different industries. We've seen this over the past couple of decades, pretty significant changes to different industries based on technology and what technology can bring to a business. So I think that continues to be a dominant force in the global economy.
Yeah, I completely agree with you there. Often marvel over how ingrained technology has become in your life. There's so many things you just couldn't do. You really cannot function without the assistance of all of these technological innovations. And it seems like the curve is actually accelerating. So, but like you said, tech in a bear market often is at your peril. But to look ahead, to look at tech companies that actually have cash flow, sustainable businesses, who knows, maybe Amazon is a steal at the current valuation.
You're certainly starting to see some attractive valuations come up through the tech sector. So yeah, I would be very focused on looking now for the types of businesses you want to invest in, and when it sort of hits your target price, if you will, or you think the market's sort of discounted all the bad news, then that'd be the time to start building positions in those businesses.
All right. Well, I appreciate it. And I should have mentioned again, your book, Global Investing, A Practical Guide to the World's Best Financial Opportunities. Thanks for holding it up. You can find it at Amazon and wherever fine books used to be sold. And another industry that fell to technology. Darrin, appreciate it. If you got a question for Darrin, want to get an answer, just shoot us an email, kl@kerrylutz.com. We'll get you an answer. If you got a question for us, hey, we're happy to answer as well. And make sure you go over to the site, financialsurvivalnetwork.com. Sign up for your free newsletter. Darrin, been a real pleasure. Thank you so much for joining us.
Thank you, Kerry. It's a pleasure.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.